to really thank our panel of judges today, especially Rashmi, Marwan, and Tarun, which is a colleague in the board of CFA Society Emirates. And this is what we do as something that we give back to the community. And then this event is really for the next generation of investment professionals. And they can start really, really early, even from their university age, to have a great feel of what it is to be like working in the investment industry in the future. These panel of judges we have right here, they are all CFA charter holders with multiple years of experience. They are very well recognized individuals in the industry. And I'm sure through this kind of event, this research challenge, our university students will have a wonderful chance to interact with them and learn a lot of the things, actually beyond what they study in the books. I think that real investment management experience or research experience is something that they cannot find it in the book, but they can have a taste of it in this research challenge. So I thanks again for the panel of judges, and also all the mentors and all the graders and the organizer, Mark, led by Bino, and our staff members who, Blessy and Evie, that put this together. And also, I would not forget the university lecturers that is leading this initiative in their respective university, from Ajman University, AUD, American University of Sharjah, Middlesex University, and NYU AD. Kudos to all of you, and especially to the students out there. And I wish you the very, very best. Learn as much as possible, build network, and wish you the best of luck in this today's competition. Thank you very much.
Thank you so much, Richard, for these kind words. We appreciate, and thanks for coming to this session today. Blessy, could you kindly allow the students to come in, please? So there are 4 people. Can you please let them all in? Hello, can you guys hear me and see me?
Yes,
Ajman University team.
Yes, we can hear you. We can see you.
Okay, who are we waiting for? I see 3 members so far.
No, we're 3 members already. Yeah, that's all of us.
Okay, so just some ground rules. First of all, welcome and thank you so much for handing over and submitting your written report. As you guys are aware, this is the final presentation and the local final of the CFA Institute Research Challenge for the 2021 season. So congratulations for reaching the stage. All your efforts are very much appreciated. As you know, your presentation is divided into 2 sections. One section is the presentation section, and that's 10 minutes. And then following that comes the Q&A session with the judges, and that's another 10 minutes. So who's gonna be hosting the presentation, the slides? Who's gonna be taking care of that?
I will be.
Khaled, right?
Yes.
Can you, Blessy, can you please make Khaled a host?
Yes, it's done.
Khaled, could you please share your presentation?
Just organizing. Now, is everything clear?
Yes.
Wait, why does it look like that? Right. Let me try sharing a different screen. Where is the option? Is this clearly visible?
Judges, can you see this?
I can.
Okay. So one final thing. Once you're ready, I'll start the timer. You have 10 minutes. Please keep an eye on the chat box. 1 minute
Mark?
before, I'm sorry. Yeah, hi, Marwan.
Mark, hi, this is Tarun.
I'm
Is
sorry.
it possible to make the screen bigger? It's coming as little small.
Yeah, your screen is coming in portrait mode. Can you put it in landscape mode, please?
Tell me because
let me.
Right. So now it's all good. I believe so, right? Arun? It's all clear
Yes,
now.
perfect.
Okay,
Perfect.
so guys, as I was saying again, 1 minute before the 10 minutes are over, I'll be saying 1 minute left on the chat box. So please keep an eye on that, right? Once the 10 minutes are over, unfortunately, I'll have to stop you to move into the next section. And that applies for both sections, right? Can you guys unmute yourselves, please?
Okay, clear.
Okay. So who's the first speaker?
Yes, I will be beginning.
Okay, so once you're done, please mute yourself and the other speaker may unmute himself and it goes accordingly, right?
Yeah.
Are you guys ready?
Yes.
Please go ahead.
Good evening, everyone. Thank you for joining us today. My name is Khalid Hakam. I am joined by my colleagues Hussam Nazar and Mohammed Saber. And today we will be going over our analysis of Tabreed. We will be issuing a buy recommendation for Tabreed with a current price of 2.65 and an expected price of 3.2 with a 2.8% upside. Our analysis reached this conclusion through the following points. Tabreed has an excellent leadership and management team, the rapid growth of the digital cooling market, and Tabreed having 72 plants across the region, making it hold a high percentage of the regional market share. As for the corporate governance, which is also a key factor in the analysis, Tabreed ensures that it meets all the legal and regulatory requirements through continuous renewal of licensing and any required paperwork. So it's holding good ethics and it values shareholders through these practices and through corporate social responsibility by following health and safety environmental procedures. As for the management, the former CEO, Jassim Thabit, had a history in the company since 2012 and ended in 2019. And he held a very high position, helped Tabreed maintain a very positive position. And taking his place is Badr Al-Lamki with over 20 years of experience in the industry. He is promising to uphold Tabreed's positive trend. The majority of board of directors are comprised of members from both Mubadala and Angie. Many of the board directors hold many high managerial positions. The chairman, for example, Khalid Al-Ghabaisi, has served as a board member for 11 years. So overall, majority of the board members altogether, have over 20 years in the industry and even in the energy field, which Tabreed can be categorized under. Now my friend Hussam is going to be covering the financials.
Now, starting with the revenue from business activities, the revenue for Tabreed has been going through a positive trend and anticipated to increase in the next 5 years. Tabreed wasn't that affected by the COVID-19 pandemic because most of its clients are from the government. Also, the net income after tax has been going through a positive period and it is projected to increase in the following years. Also, Tabreed had made some acquisitions and investments in the past years, like acquiring an 80% stake in a property developer in Mars downtown Dubai, and that's expected to increase its earnings in the future as well. The return on assets has been positively increasing throughout the years, but it's projected to decrease in 2020. But this puts it at 4.68%, which is more. The return on equity has been improving throughout the years and it's also projected to increase in 2020. The average collection period is in the first 2 years, but then in 2018 it started to increase again. It's projected to increase in 2020. Nothing is to worry about here, as it increased 2020, which means the government asked for some leeway for the payments, and the grid gave it to them. The time interest earned has appreciated during the analysis period, expected to reach its highest point in 2020 since 2018, with 5.03 times interest earned expected to be in 2020. The company is presenting less of a risk to investors and the creditors in terms of solvency. The debt to EBITDA has been declining from 2015 to 2019, which is a good sign. The increase in debt has been primarily due to acquiring the 80% stakehold in the property developer Emaars Downtown Dubai. So nothing to worry about for investors. The interest coverage has been shifting up and down with a small amount throughout the years with no significant changes. The
I'm
current
sorry,
ratio,
Hassan, your voice keeps coming and going. I'm not sure what's the issue here. Is it the mic? Is it too far?
okay, just wait 1 second.
Yeah, no, it's happening for me as well.
Yeah, I think it's an issue on his mic.
I think it's the first time this happened, but okay, I
That's
continue
okay.
now.
I've stopped the timing for you. Yeah, please go ahead.
Okay, so the current, what you can hear me? Okay, the current ratio has been going through a positive and negative trend. It has always been above 1, which is acceptable and means that the company is able to meet its short-term obligation. The same goes for the quick ratio, as it has been going through increasing and decreasing spells, but it's forecasted to be above 1 in 2020, which is something that the investors will be attracted to, as the company is liquid and has no problem in paying off its debt. To reiterate, the revenue has been going through a stable growth for years. Also, the earnings per share has been increasing throughout the years.
We have three influencers of share price appreciation. First, we have high forecasted revenue, and that is due to the forecasted growth of the district cooling market size and high consolidation and bigger market share acquired. And that is when Tabreed decided to acquire assets in Abu Dhabi and downtown district cooling in Dubai. We also have the forecasted growth in district cooling industry as a whole and globally. We have a WACC of 7.41%, and that means that we need at least we need a minimum return of 7.41%. We use the cost of debt of 3.96% and the cost of equity of 10.43%. A beta of 0.38, which shows that the stock is not very volatile, or it's not volatile at all. We use the US 10 years T-bill for a risk-free rate of 0.93%, which is adjusted to inflation to 2.34%, and we use a return on equity to find the terminal value, which was 9.97%, and we also use a market rate of return of 23.6%. For the terminal value, we forecasted the 5 years free cash flow, and like we said, for the terminal value, we use the WACC and the return on equity in order to discount terminal value of 10,447.6. This is a positive indicator because the 5 years show a positive free cash flow. As for the capital expenditure, it was high in 2020 due to the new consolidations. It is expected to decrease over time, and this graph shows a 5-year average of forecasting of capital expenditure. For our market risk analysis, we have 4 risks, which is the first one is market risk. Our market risk is the energy market volatility results in a better cooling alternatives, which means that our alternatives of cooling will be can be cheaper, which can cause a competition to the district cooling industry. The severity of this risk is low, but the likelihood is medium. Our financial risk is the potential of loss in investments made in Emaar downtown district cooling due to the global pandemic. The UAE might witness a decrease in its tourism, which can decrease its use of district cooling. The severity of this risk is medium, but the likelihood is low. For our credit risk, we have increasing debt due to recent acquisitions in Dubai and Abu Dhabi. This means that the company will need to have more higher liquidity in order to cover its debt obligations. The severity of this risk is high, but the likelihood is also low. We have finally the liquidity risk, which is the possible lack of liquidity required to pay off future acquisitions related to debt, which means that the company needs to decrease its receivables. The severity is high, but the likelihood of this risk is medium. For our SWOT analysis, we have our strength, which is operational track record, our relationship with the IDAR, and being the largest district cooling company in the area. Our weaknesses is high financial leverage dependency and material reduction in contracted revenue. The opportunities are geographic growth opportunity, especially in the GCC, investments in organic and inorganic projects, and increasing popularity of district cooling worldwide. The threats are DC market growth can invite international competition, and the deal aversion process can take a long time. Our conclusion is that Tabriz has an environmental sustainability advantage, future revenue growth, industry stability, and the high market share acquisition. But it also has high leverage and debt, macroeconomic instability, high capital expenditures, and volatile energy markets. Thank you for listening.
Thank you very much. Judges, it is now the time for the Q&A session. Please open your microphones and camera. We're gonna take this in alphabetical order. So Marwan, then Rashmi, then Tarun, please. Just to keep a good order for the Q&A. Marwan, are you ready?
Team, yeah, can you hear me?
Yes, whenever you're ready, please let me know. I'll start timing.
All right. Probably 2 or 3 questions I have on my side. Can you tell me about, first of all, in your analysis, the return you said you've seen there have been some kind of increasing return on equity, and can you relate that to the level of debts that the company have been acquiring? And at the same time, if you can highlight the recent acquisition that the company did and the rationale behind that. So if you can start with this one, maybe I'll then jump to the other ones.
So for the first question, you wanted to link the cost of equity to the
not the cost of equity, the return. You've been seeing an increasing return on equity, and I just want to understand your rationale. Why do you think that higher return on equity? Is it related to I don't know if you did any DuPont analysis, but is it related to leverage? Is it related to higher return of services or pricing of the company? Or is it a measure of probably recent acquisitions?
We can say it's a mix of expected returns on current operations, because the company had a great test during the pandemic, and that is it wasn't affected by the pandemic because mainly their main clients are governmental institutions, which means that the profit will keep growing in the future regardless of the circumstances. And it is also related to the recent acquisition, which we believe are going to pay off.
Okay, Sabir, just on the profit that will keep on growing, can you just give us a kind of a very briefly, what is the pricing formula for the company? How they kind of dictate the tariffs they charge?
As in their pricing plan?
Yeah.
So I believe that they have 2 types of charges, which is a fixed charge and a variable charge. The variable charge is called also the capacity charge, which is fixed, and the variable charge is dependent on the use of district cooling.
And the variable charge, how is it like decided? How they decide on that variable? How do they decide that we're gonna charge you this amount?
I think it depends on the capacity, as in how much kilowatts are being set as a capacity, and they charge per kilowatt. Or I think that is it.
Okay. Maybe I'll leave it to the other judges if they have questions. If we have time, maybe I'll ask another question. Thank you. Thank you.
Hi, everyone. This is Rashmi. Can you guys hear me properly?
Yes.
Yes, we can.
Okay, yeah. So, my first question is simply on the top line. So, you have shown the numbers till 2020. However, I don't see the forecasted revenue numbers on the presentation. What are the key drivers of revenue growth that you've taken for the company?
We have forecasted some revenues. We didn't put it in every slide, but it is present. So your question was,
Right.
how did we achieve these forecasts?
Yes, that's right. What are the key drivers what are the inputs or the assumptions that you used in order to forecast this revenue growth?
Well, there is the basic one, which is the current trend in the market, that the district cooling is a growing market and is in high demand. There is also from previous business activities. There's also some models that my colleague Mohammed has done.
There's
Okay,
also
so I mean,
sorry. There's also the expectation that the revenue is going to grow as the economy is going to recover from the pandemic. I mean, the company already made some decent profit during the pandemic, and we expect it to even increase in the future after the economy recovers.
Right. And you guys used, discounted cash flow as the main valuation technique for the company. Did you consider other valuation methods like dividend discount model or, relative multiples? And if not, why not?
We did consider them, but we were a little bit tight on time, so we couldn't get to finishing them. But we also thought that the discounted cash flow is also enough to forecast our target price.
Okay. And, in terms of you've mentioned about the leverage. How do you, going forward, what have you assumed regarding the leverage? How do they pay down their debt? I mean, how have you built the high levels of leverage into your analysis?
Company did take a loan of 692 million that's expected to be paid in 5 years. So this is one way that they're expected to pay off their debt. Leverage.
Okay, and have you thought about? I mean, right now, if you look at the global economy, and as you know, the UAE dirham is pegged to the US dollar, so there's increasing bond yields in the US right now. There's a risk of inflation and the risk that the interest rates will rise. Now, if that happens, then highly leveraged companies do get impacted. Have you taken that consideration into analysis?
We didn't take consideration into that, but we can say that it's going to highly affect the breed, because with the current situation, it will have to decrease its receivables in order to afford at the current rate. Increasing interest rates are going to form a problem to the company.
Okay. Thank you. I'll give way to the other judges.
I think the benefit of coming last is all the intelligent questions have already been asked. So I don't really need to put too much effort. But yeah, just staying on this slide where you've computed WACC, what exactly do you mean by market rate of return of this 23.6%?
We calculated the change in the DFM index price, and we used it as a market rate of return.
This is for what period?
I think this is for 2019, the last year prior to the pandemic.
Okay, so generally, most analysts, when they use market returns, it's for a much longer period. But okay, also on this same slide, you have U.S. Treasury bill of 0.93, which you used as your risk-free rate. Plus, you added an inflation of 1.4%. Is this generally the risk-free rate already including inflation expectation built in, or do you think that you need to add inflation separately in that?
No, I think it's not accounted for inflation usually. That's why we included the inflation rates, because this is the real interest rate. The one that's provided online is the real interest rate. We had to include inflation for us to get the actual risk-free rate and account it for inflation.
Okay, cool. And cost of debt 3.96. Where did you get that from? Okay, never mind. Can you move to the next slide? Because I think we didn't have the next slide where you have the DCF calculation. So when I received the presentation yesterday, I didn't know what valuation methodology you were using. But it's good to see that you've done projections and you've done free cash flow projections. So, okay. And so when, Mark, you have a comment here, but I can't see how you've arrived at, the computation of your target price. Even in this slide, typically in your valuation presentation, if you're using only DCF, and I think there are many more models available that one should consider, but you don't present how you've arrived at your DCF. So I guess we are running short of time, so I'll leave it over there. Yeah, I think other methodologies were probably important to consider. There are business questions that I had, but I guess we are short of time now. So.
Am I allowed to answer that question before we finish?
Sure, please go ahead.
We didn't have enough time for us to put all the slides because it's not going to be enough for this presentation. But the terminal value was used to get the enterprise value, and we used the enterprise value in order to find what we think is the fair price, share price. So that is how we got the target price.
Right. No, that's great. That's great. Generally, if you just show it in the presentation, like your enterprise value less your debt divided by number of shares that you're assuming, and then arrive at your recommended price, that is generally very useful for people to look at. But thank you.
Thank you guys so much. The 10 minutes are now over. Thank you, Ajman University, for this. You'll be receiving your grades, the written reports, plus the current presentation in the next 24 hours. Thanks again for showing up. Thanks for all your hard work and efforts. Please expect an email from me.
Thank you.
Thank you for this opportunity.
Thank you so much. Thank you.
See you.
Could you kindly, yes. So, could you please allow, let's see, allow the other participants in the room? I believe there were 6, I'm not sure.
Mark, do we input do you have time for inputting the scores before we forget about things, or can we get a 2-minute or 5-minute break, or not possible?
Can we start at 1:35, please? Is that possible?
Yeah, definitely.
Yeah, because otherwise we'll forget the comments.
Yes.
We can still remember the grades, but we might not remember the comments. So
right.
Maybe
so
just...
I'll welcome the new team while you write down the comments. Yeah.
Good.
Okay. So welcome AUD team. Thank you so much for showing up. Thank you again for submitting your written report to us. It has been graded, and you'll be receiving your grades along with the grades of this presentation. Of course, all your hard work is much appreciated, and thank you for being a part of the CFA Institute Research Challenge 2021 season. As you know, This presentation is divided into two sections. First section is the presentation section, where you have 10 minutes to present your findings, after which you will have another 10-minute section with judges for a Q&A, after which you will be wrapping up and you'll be receiving your grades within 24 hours. So who's going to be sharing the presentation and taking care of the slides?
That will be me, Maria.
Blessy, can you kindly make Maria a host? Blessy, can you hear me? One second, please.
Yes, I believe she got disconnected. 1 minute.
Yeah, I think she connected back.
Hi, sorry, I think I was removed. Hello?
Yeah, apologies for that. I think maybe it was done by mistake. Blessy, can you please make her
Yeah,
host now?
I made her a co-host. Yes.
Okay. Can you try and share your presentation, Maria, please?
Okay. It says host disabled attendee screen sharing.
Yes, can you try it now?
Can you see my screen?
Yes. Judges, can you see? All good. Okay, so you're going to be the first speaker, Maria, or someone else?
That would be me as well, yes.
Okay, so guys, just basic ground rules. Whoever is speaking is allowed to unmute him or herself. Everyone else should be mute. Please keep an eye on the chat box. 1 minute before the end of each session, I will mention 1 minute left, in which case, please wrap up and conclude, yeah? Whenever you're ready, I'll start the timer, so please let me know.
Okay, I'm ready.
Cool, good luck.
Thank you. In one of the hottest regions in the world, we undoubtedly expect a booming hub for the district cooling industry. Hi, we represent the American University in Dubai, and today we evaluate Tabreed, a district cooling company headquartered in the UAE with growing regional operations. Our valuation recommends a hold with a target price of 2.86 dirhams per share, representing a 3% upside.
District cooling is a centralized production and distribution of chill water through underground insulated pipes. Tabreed benefits by holding a long-term 25 years contract with its clients that helps them generate 97% of the overall revenue from the chill water segment and 3% of the overall revenue from the value chain segment. The remaining 62% of the chill water revenue is coming from the capacity fee, which is a fixed cost charged to the clients that helps Tabreed cover their initial investment costs. The remaining 38% of the chill water revenue is coming from the consumption fee, which is a variable cost charged to the clients that helps Tabreed cover their operational expenses. Tabreed's regional experience, a positive increase in recent revenue, and rapid expected growth are all driving factors that acts as a competitive advantage for the company Tabreed to grow in the region and countries abroad.
As to competitive positioning, we compare Tabreed to our two main local competitors, Empower and Cool. We also compare Tabreed to regional and international peers, which many of them are not actually considered competitors as they operate in conventional cooling and are quite distant to where Tabreed operates. Empower leads the UAE market share, followed by Tabreed, and lastly Emicool. And the threat to Tabreed is competitive rivalry, followed by the bargaining power of suppliers. The UAE's GDP has been fluctuating for the last 4 decades, and declining oil prices impacts the UAE economy negatively. Despite all of that, Tabreed continues to grow, and the increase in residential supply units has complemented that growth.
Tabreed has outperformed the DFM since the year 2016, driven by both strategic acquisitions and capacity growth. With the newly signed contract to build India's first district cooling plant, as well as the recent purchase of an additional 8% stake in their Saudi operations. Our 2021 projections presents a 14.5 times EV/EBITDA and a trading PE ratio of 24.2 times. Coming to our investment summary, what are the main key drivers and risks that lead our hold recommendation? We boil them down to 4 main. The first driver being Tabreed's defensive industry as well as expansion plans, the efficient innovation of district cooling over conventional cooling, the stable returns Tabreed has shown. However, the company has recently found itself in a highly leveraged stance.
So beginning with the first driver, which is Tabreed operating in a defensive industry. Tabreed enjoys the advantage of having long-term contracts with governmental entities, which represents about 70% of Tabreed's total revenues. Tabreed also has many prominent customers, such as the Dubai Metro and the Bahrain Financial Harbour. Tabreed has expansion plans and has already expanded within 2020 through the acquisition of I'mar and Saadiyat, as can be seen in the added capacity. And the global forecasted compounded annual growth rate over the next 4 years for district cooling services is about 13.2%. However, we were more conservative with our numbers and got to about 5.69% growth rate for Tabreed.
The second driver is the efficiency of district cooling over conventional cooling. As an innovative substitute, we see annually reducing CO2 and energy consumption, as well as district cooling plants having a longer lifespan than conventional cooling. This leads to a higher cost efficiency and decreasing overhead costs. Additionally, the constructive major shareholders of Tabreed, Engie, and Mubadala are both energy and cooling industry giants. These support the strategic growth and development of the company, as well as their share in the board of directors.
Tabreed has exhibited consistent growth in their annual dividend payments in the past, and we forecasted constant dividend payments over the next 3 years. We were concerned whether they will be able to increase their annual dividend payments due to their high leverage. Recently released 2020 Q4 financial statements actually revealed that the DPS value increased from 10.5 to 11.5 fils, which shows confidence in Tabreed's ability to generate healthy cash flows. Recent acquisitions pushed debt levels to new heights. The net debt to EBITDA ratio jumped from 3.4 to 6.5 times, which can potentially limit Tabreed's expansion plans and dividend growth. We also factor in our concerns regarding the 2 upcoming bullet payments in 2025. Moving on to our valuation and risk methodologies, our target price for Tabreed is 2.86 dirhams per share, representing a 3% upside. A DCF, DDM, and relative valuation methodology was used in our analysis, allocating a weight of 80%, 10%, and 10% respectively. The DCF contributes the highest share to our target price due to the stable cash flow generated by Tabreed. Our bull case scenario obtained a target price of 3.37 dirhams per share. The terminal growth rate of 2.07% was forecasted using the GDP growth rate, the inflation rate forecast, and population growth predictions for the UAE. A WACC of 7.87% was utilized, obtained from a cost of debt of 3.92% and a cost of equity of 10.33%. The 10-year US Treasury rate was used as our risk-free rate, and beta was calculated using 5-year historical data. The cost of equity was calculated using a CAPM and DCM methodology. Our DCF yielded a target price of 3.13 dirhams per share. we were quite conservative when forecasting the annual capacity additions which drive revenue growth.
For the relative valuation, we computed the dividend yield and PE of Tabreed's peers. As Tabreed paid dividends for the last decade, we assigned a higher weightage of about 80% to the dividend yield as compared to 20% for the PE.
The ABV methodology was used to produce a target price of 2.21 dirhams per share. However, it was not allocated any weight in our valuation due to the fact that it includes the value of the district cooling plants at cost. However, we did consider the ABV target price as being our bear case scenario for the Tabreed stock.
We observed three main risks here. Due to the fact that the company's average daily traded value is approximately 3 million dirhams, the first would be liquidity risk. Secondly, on the operational front is the increased leverage risk, as mentioned previously. Lastly is the regulatory decision risk. This could ultimately affect Tabreed's earning potential. We ran a sensitivity analysis to determine the impact of these risks on our fair value. Just as an idea, for every 25 basis points that changed in the WACC, caused a change of 8 to 9% on our fair value.
ESG strategy is, of course, very crucial. When evaluating Tabreed, we saw room for improvement under their social responsibility and, of course, environmental sustainability. We rated them a 4 out of 5 in environmental sustainability due to their reducing consumption, as well as innovating solutions underway to shift towards seawater or treated sewage usage, and enhancing operational efficiency. However, we did rate Tabreed a 3.5 out of 5 in social responsibility, because although they maintain rigorous health and safety standards and supplier relations, there is still room for growth in their youth, development, and humanitarian initiatives that they maintain in the communities they operate in. However, Tabreed has shown exemplary corporate governance with a strong and transparent internal control structure, investor communication, and regulator oversight against the DFM. In consideration of the pool between the positive and risk-based drivers that we discussed today, this is the reason we are issuing a hold recommendation with a target price of 2.86 dirhams per share. This is representing a 3% upside. To recap, the main drivers and risks are the defensive industry Tabreed operates in, the efficient innovation, stable returns, however, the highly leveraged stance. With a slight weight between the positive and stable growth, yet spiking leverage and interest, risk over the next 5 years may be evident for the investor. And while we advocate a strong hold for Tabreed, should the market correct itself, we would recommend a quick pickup at stock price dips for this security. Thank you very much for attending our presentation, and we would like to move on to any questions from the judges.
Thank you, guys. Smooth presentation, I have to say. Judges, are you ready? As usual, can we start with Marwan, please?
Yeah, thank you, Mark. Well, to be honest, well done, team. Its presentation looks really, you did a lot of effort here. So I'll just try to, you mentioned leverage throughout your presentation, how it affected your valuation and how you consider that into the overall picture of the company. So how do you see leverage for this company? Did you see it as something positive? Are you comfortable with the leverage? And as well, you highlighted that you're concerned about a bit about the bullet payments. Do you see that moving to refinancing, or so do you prefer leverage, and how much leverage you prefer in the company? Let's put it as simple as that.
Right. So at the moment, our main concern regarding leverage is the fact that it generates quite a lot of interest expense. Even in our forecasted EPS value, the EPS would decrease, and we were very concerned about that. So yes, we do understand that Tabreed is currently going through this process, this transition period of trying to expand and achieve their expansion plans. However, the impact that it has on a short-term basis is quite significant. So we believe that leverage at the moment generates too much interest expense compared to how much Tabreed generates. And we do wait for these expansion plans to be reflected within the revenue to be able to compensate the increase in interest expense. Right, you're mentioning about the bullet payments. We believe they might be going for refinancing because there is quite a lot. Those bullet payments are considerable, and I have doubts in their ability to pay them just as they are. So they will definitely need to find out a different strategy, most probably refinancing for the 2 bullet payments for 2025.
So do you have concern of the company's current cash flow generation for it to be able to meet or to deleverage the balance sheet of the company? Or do you think they will be capable of doing that?
Oh, definitely, yes. They will be able to generate the cash flow. We can say that about Tabreed. Among other companies, Tabreed is one of the few companies which truly has stable cash flow. Because let's not forget, 97% is chilled water revenue. Out of that 97%, we have 62% capacity revenue. That is generated by what? That is generated by 70% of those is long-term contracts for the next, so 70% of them long-term contracts with governmental and semi-governmental entities. And these contracts are for up to 25, up to 30 years. So we have that capacity insured, and we are confident in the ability of the government to make their payments, even if they might be delayed, for example, due to COVID, which actually broke a bit that seasonality in their collection of accounts receivable, which normally happens in Q3 and Q4, right?
Thank you, Alexandra. That's good enough. I've got the picture. Please, Rashmi, feel free to ask your question.
Thank you.
Well, guys, very well presented. Really, I really enjoyed your presentation. So accept my compliments. And I just have a couple of questions for you guys. So one is, you mentioned your revenue forecast being slightly conservative as compared to 9% growth for the global industry. And then you mentioned about 6% for Tabreed. What goes into that? How do you, what assumptions did you have for that revenue forecast?
Yeah, actually for the global forecasted growth rate for the district cooling services industry, it was influenced a lot by the growth within India and China and district cooling services. Mm-hmm. However, when we assess Tabreed is currently located in the UAE, and it has like other plants within the GCC. The GCC is currently saturated, or it is more saturated than India and China in terms of district cooling services. So we had to lower our expected growth rate for that.
Right. And did you guys consider the fact that, the property outlook for UAE currently is not as great as it used to be? Property is cyclical, and right now we are going through a more of a oversupply phase. Does that impact your assumptions anywhere?
I could answer that in the assumptions that we did in our forecast. We did consider, and that was actually also driven by the COVID impact. There's been a slight depopulation of about 4 to 5%. What we did, we factored that in as negative growth in price per KRT in our model. Of course, we have consumption and capacity, and it was expected for consumption to decrease. So we have negative growth in 2020. However, the forecasts have been quite positive regarding population, regarding inflation for the upcoming years. And in addition, when it comes to this discrepancy between 13.2 and 5.69, our capacity additions, we said that we were quite reserved. What we mean by that, we consider the 30 to 40 KRT, which is normally an annual capacity addition, which is normally pursued by Tabreed. We also consider the Saadiyat expansion for the Saadiyat plant, which is about, at the moment, they're on 24 KRT and they need to reach 88 KRT in about the next 4 years. So 16 KRT has been considered for every single year for the next 4 years. And then we also consider the India plant, and just the current India plant that we know about in 2022. The news did mention on Tabreed's website that the plan was supposed to be operational in 2021. However, they haven't mentioned anything about it. So we believe there might be some delay due to current condition. So we factored that in 2022. So that's what we mean by this discrepancy between 13.2 and 5.69. We did not want to be too generous when considering capacity addition, which truly drives revenue growth.
Right. Okay, and then my second question is regarding the weightages that you gave to different valuation methodologies. So you gave 80% to DCF, and then the remaining weightages. What went into that?
So regarding the DCF methodology, it received an 80% because Tabreed is truly a company that generates stable free cash flows. And these cash flows are truly reflect the performance of the company. On the other hand, the dividend discount model, although they have been generating dividends throughout the historically, and they've been quite consistent and increasing their dividends, we've been quite concerned due to their high leverage, whether they will be able to increase those dividends, right? Yes, it is true they have increased the dividends from 10.5 to 11.5 fuels, which I believe is related to the fact that they're selling their shares in Qatar, in the Qatar shares, it's in the recently released ones, and that is related to the fact that they're trying to send the message to investors that we're doing fine, don't worry about anything. But because of the huge increase in interest expense, which is not even fully factored in 2020, right? We were very conservative when considering their ability to increase their dividends. So that's why hence the 10% allocation. And for the relative valuation, Mohammed?
No, it's fine, guys. You guys can go ahead. It's fine. Yeah. Thank you. Tarun, you can go ahead with your questions.
Yeah, guys, thanks. I think you did a great job in your presentation. I just have a few questions. Can you go back to the slide where you have the PE ratio and explain to me how you got the PE ratios of in high 20s? Because from what I see, their EPS is 20 fils and their share price is, yeah. So the EPS is 20 fils and the share price is around 2.8. So that works out to around 14.
Yes, so I can definitely go into that. So can you hear me?
I can, yes, thank you.
Yes, so the PE ratio might at first seem quite high. This PE ratio has been forecasted for the year 2021. Now, in our forecast, 2021 represents a transition year, and EPS will normalize by 2023 and 2024, which will bring down the PE ratio to around the industry average. However, we do believe that the PE ratio is not an effective instrument that reflects the performance of the company, and that is due, like in terms of comparing it with the other competitors in the industry, because we don't really have true direct comparable peers and competitors, right? That we can make this comparison with. Equal and Empower, they do not release their financial values, and that kind of limits our ability to make that comparison, first of all. Second of all, let's not forget that not only now, in last week, in 2020 financial statements, Q4, they just mentioned that they will be selling their Qatar shares. Now, Qatar shares are divided into two contributions, 2020 contribution and 2021 contribution. That 2020 contribution has been reflected of about 100K increase in their net income, which goes from about 460, which is our forecasted value for 2020, and hence it continues to 2021. It would also be projected, and we increase the EPS value, hence decrease the PE ratio. Does that answer your question?
No, not at all. But these are factual matters. Like the EPS is factual, and unless you expect the EPS to be going down in future, the PE can't be kind of increasing. It has to be decreasing.
We expect the EPS to be going down.
You expect the EPS to go down?
In 2021, and then slowly increase until 2024 to go back to a normal value. That's our expectation due to the high expense.
Right. I could not make that out from your presentation elsewhere. But quickly on the business side, they have.
Sorry, guys. Last question. Yeah, let's keep it short and simple. Just one question.
Right. They had this large jump in intangibles. Can you explain what was that in their financials? The large jump in intangible assets of $2.2 billion dirhams.
Sorry, which slide?
In their 2020 financials that came out, there's a large jump of $2.2 billion in intangible assets.
Yeah, those are contracts. The contracts that are being they currently have from the MR acquisition and implicitly also the Sadiat acquisition. But mostly they come from the MR acquisition.
Yes, thank you. Thank you very much. Thank you, guys.
Thank you.
Thank you very much, guys. Much appreciated. Again, well done on a great presentation. You'll be receiving your amalgamated grades in the next 24 hours. The written report plus the presentation, right? So stay tuned. Again, thank you so much for tuning in and stay in touch. Thank you.
Thank you so much for
Thank you so much. Thank you, judges.
Have a good rest
Thank
of
you.
the day. Thank you.
Thank you. Bye-bye. All right, guys, I think there's a good time to note down your take notes. So judges, I think for the next two presentations, we will do it in reverse alphabetical order just to give a fair chance, because usually Tarun ends up with around 1 minute or a minute and a half or 2 minutes and he doesn't get enough time. So let's do it Tarun, Rashmi, then Marwan for the next two presentation. And in the last presentation, we'll start with Rashmi, right?
Yeah, sure.
Mark, which is the next team?
AUS, American University of Sharjah.
Okay, thank you.
Most welcome. Just to confirm, are you guys facing any issues with connectivity with your grading rubric, with anything?
I'm all good.
Okay.
Yeah, good for me as well.
Okay.
All good here, Mark.
Okay, great. Thank you. can you please confirm what's the status on the remaining team members?
Yes, I have one more team member who will be presenting with me who is trying to join right now. She's just having an issue saying that it says that she's unable to join, so she's trying again now.
So it's only two of you, right?
Yeah, we'll be presenting.
Have you received my invitation email, or that wasn't shared with you?
And that wasn't shared with me earlier. I received it when you forwarded it to me today.
Okay. Is that going to be sufficient for you to present with two members? Because I don't want you to have an unfair chance simply because of the logistical issue that you didn't receive the email from the professor.
I mean, if it would be possible, we would definitely be very grateful if we could present on a different day, because we didn't know that we were presenting today at 2, which is why we're late, and I apologize.
Oh, that's perfectly fine, but the day is not the issue, because we confirmed multiple times that today is the presentation day. The time was settled yesterday, right?
Mm-hmm. Yeah.
So how long do you need to gather the remaining team members?
Can we have like 2 hours, for example?
Because I'm not sure. The reason is that the judges are on a very running a very tight ship here, and they should be off at 4 p.m. sharp, right?
Yeah.
Because we also have two other teams presenting from 3 till 4. So judges, would you be Lydia? I need to know first if you'd be able to get the other team members sharp by 4, and that's contingent upon the acceptance of the judges, because they may not be available at the time.
I'll need to call them right now and make sure, but I think that should be possible. Yeah.
Lydia, can you represent yourself? Can't you do it alone?
The whole presentation?
Yeah.
You and Mariam.
Yeah, I could do it along with Mariam. Yeah, we could do that.
Okay, so
go ahead and
unfortunately
do
we'll
it
have
then.
to go with this. Yeah.
Yeah, I would not be able to, I wouldn't be available after 4. I have an appointment at 4:30, so unfortunately, I would need to leave by 4.
So unfortunately, Lydia, we're gonna have to go with this, and let's take this issue separately with Dr. Chris as to why you didn't receive the email that I've sent you.
I guess he received it, but I think it was sent on Friday, so maybe he just didn't open his email. Sometimes he doesn't open his email on holidays, so.
Okay, so we'll take that separately. Yeah.
Yeah.
So are you gonna be sharing your screen, or is it Mariam?
Sure, Mariam, can you hear us? Are you here?
Yes, I can.
Okay. Can you make let's say, can you make Mariam a host to share a presentation?
Done now.
Lydia, do you have the presentation ready already?
Yeah, sure. Okay, I'll share it.
Okay.
Let's see. I'm sorry. Can you please make Lydia the host? You know what?
Lydia, you can share your screen now.
Okay,
yeah.
Thank you. Just 1 second. Can you see the screen?
Yes, please go ahead. So as you know, there are 20 minutes, 2 sections. First section is the presentation. You'll be presenting exactly for 10 minutes, and 1 minute before the 10 minutes are over, I'll say 1 minute left, in which case, please conclude and wrap up. Then you'll be entering a new section, a Q&A session with the judges, right?
Mm-hmm.
So all the best. Whenever you're ready, please let me know.
Yeah, I think we'll start now. Yes.
Okay, please go ahead. Thank you.
Okay. So good afternoon, everyone. Today we're going to be presenting our findings regarding our financial analysis about the company Tabreed. We're going to be starting with an introduction about the company, and then an overview of the investment risks and the market, industry and market analysis. And we conducted a benchmark analysis as well. And finally, we're going to be discussing the valuation and the investment risk and our recommendation. Okay, so Lydia, you want to start?
Sure. So to start off, Tabreed is a sustainable, environmentally friendly provider of district cooling solutions. So basically, it has two distinct segments in its business model. It provides chilled water, and it has a value chain business. So it does the design, financing, construction, operation of the district cooling plants. And it's a very big company in the UAE. Its main operations are in the UAE and in the GCC regions, and it's one of the leading cooling solutions provider. So the business model of Tabreed is that it has a B2B business model. So it works with other businesses, and they provide these district cooling solutions through working with other businesses and through their utility infrastructure business model. So they have basically a fixed charge that they charge their customer and a variable charge. And the fixed charge is the kind of the safer part, because it doesn't really depend on how much customers are using the cooling service, but the variable part is dependent on how much the customers are using the service. So the board overview, basically it consists of 9 seats on the board of directors, and the ownership is mostly shared between Engie and Mubadala. So Engie is a very big company in energy and cooling solutions. It is a French company, and it has about 4 out of the 9 seats. And there's also Mubadala, which is a UAE-based, wealth fund, and it contains some of the other seats on the board of directors. So the main investment risks that come with investing in Tabreed are the industry risk, the country risk, the liquidity risk, and solvency and leverage. So when it comes to the industry risk is very low, because the demand for district cooling is projected to triple by 2030 in the GCC. And so there's very low demand risk, because of course the weather in the UAE and in the GCC is projected to stay hot, while the population is projected to grow. So the demand will continue to grow, and there's almost no demand risk. When it comes to the country risk, so Dubai itself is projected to grow by 1.5% to 3.8% in 2021, meaning that it will kind of be coming out of the recession that it got into due to COVID-19. Abu Dhabi is also projected to grow by 1.5% to 3.6%. And this is because of the resurgence of some of the industries, for example, tourism. It is because of the stabilization of oil prices compared to what happened last year, and so on. The currency is pegged to the dollar, so there is very little currency risk, and there's also political stability. So in general, the political risk in the UAE specifically is very low. And the inflation is projected to be 1.5%, which is a very reasonable number. So overall, the country risk, which includes the economic risk, the political risk, is quite low as well. So when it comes to liquidity, here we analyzed the company and we looked at their current ratio, cash ratio, and their clients in general. So their current ratio is 1.4 times. So that is a pretty high ratio. It was on a safer side. And when compared to benchmarks, it is actually outperforming many of the benchmarks. When it comes to cash ratio, it is 0.2, which sounds quite low, but the reason for that is because a lot of the assets that the company has is in accounts receivable. So that means that the cash part of the assets is quite low. But the accounts receivable, most of them are held by big clients, such as government entities. So there's very little risk of the accounts receivable not being collected. Therefore, the overall liquidity risk is also very low. Finally, when it comes to solvency and leverage, so the corporate structure is 56% equity and 44% debt. So that is a little bit almost like half-half. and the debt ratio is 0.44%, and the interest coverage is 3.66. So it means that the company is doing its interest payments very comfortably. So again, this risk is quite low. So overall, the investment risks that come with investing in Tabreed are all quite low, both when compared to the benchmarks and in general, for example, when looking at the country risk. And now I'll pass on to Mariam to talk about the ESG.
So when we talk about the ESG regarding Tabreed, they have run several programs, a lot of which are focusing on including university students, especially science and engineering majors, and kind of including them in their operations and giving them employment opportunities. They hold so many training programs, and they even provide touring for university students. They try to really extend their outreach to universities and the academic field, trying to not only market the company, but even increasing awareness about district cooling in general. The company itself within its operations has been working on reducing its carbon footprint very effectively. And even with the use of energy, they've tried to minimize as much as they can their carbon footprint, and they've been presenting this information in their very recent financial reports. If please you can go to the next slide. So when we conducted an industry and market analysis, we found a few competitors. Now, the thing that we have to mark is that the main competitors of Tabreed are all not publicly listed, although they might have a similar market share or operations. Emicool, its main competitor, also based in the UAE with most of its operations in the UAE, is not a publicly listed company. So this is definitely a point that goes to Tabreed. And Emicool, which is its major competitor, has a quite different business model, and not like Tabreed, it actually also takes into consideration the individual consumers and does not just do B2B business. Empower and HVAC and refrigeration are also major players in the GCC market specifically. But as I said before, Tabreed is the only publicly listed company. Next, please. The next slide. We conducted a benchmark analysis. Now we used the Dubai Financial Market Services Index, which is one of the DFM indices, and it includes the 3 companies of which Tabreed is one of. The other 2 companies are also service companies. Now, this was the best publicly listed, as I can say, benchmark that we could use, as there is, as I mentioned, no other district cooling company that is publicly listed. And as we can see, compared to this benchmark, Tabreed is actually very consistent in its when we look at ROE or its earnings, and even we can see an upward gradual trend. Now, when we look at the PE and PB ratios, also we can see that Tabreed has been consistent with the benchmark there, so it's actually performing as good as the other comparable companies. And when we look at debt, most importantly, I think, as Lydia mentioned, a huge factor in its consistency and net debt is basically the fact that it only has contracts with major developers in the region or governmental entities. So even its earnings and debt is really under control. Next, please. Now, quickly for the valuation, we used the dividend discount model because starting 2016 and actually from before even, Tabreed has been providing consistent dividends. And we found out that the target price is 3.3, which is a bit higher than the current price. If you can go to the next final slide, please, Sadia. The final slide, yeah. Yes, we finally gave a buy recommendation because we think that the share price is undervalued and there's still prominent growth prospects for Tabreed, as it really does signs huge contracts with developers, major real estate developers in the region, and it's been expanding in Dubai specifically.
Thank you so much, ladies, for that. Now we're gonna enter the Q&A phase with the judges. Let's start with Tarun, Rashmi, then Marwan, please. We have 10 minutes sharp. Please, go ahead.
Thank you, ladies. Great presentation. I just have concerns on the data that you have used, because some of the financial data that you seem to be using for historical purposes is slightly different from what I have. So if you can just go to slide number 6, I think the one before ESG, where you talk about debt equity ratio. So if I look at 2020 financials, the equity is 2.7 billion and the debt is 6.4 billion. It's not 56-44 debt equity ratio. So I don't know, these numbers seem to be a little off. Even the current ratio numbers and cash ratio numbers, these numbers seem to be like way off from what I look at in the 2020 financials. So where did you get your financial data from?
I think this was the last quarter of 2020.
But that's published data. That doesn't seem to match what you're saying over here. Okay, let's move on. Your methodology, you use dividend discount model, and I'm sure you would have noticed that in 2020, there's been a significant fluctuation in the capital structure of the company. So, the debt equity ratio has changed significantly. Do you think it's appropriate to use something like a dividend discount model when the capital structure changes so significantly?
We took into consideration that, but the reason why we use the dividend discount model is really the consistency of the dividend payout in the company, and their aim to actually make it consistent and even increase it gradually. So that's why we use the model.
Great. I have some business questions, but we'll come back to that maybe after other judges have had some time to ask questions here. Over to you, Rashmi.
Yeah, thank you. So hi, ladies, good effort there. And I wanted to ask you the questions on the slide, where you're comparing some of the financial data from the company to the services index, this DFM services index. You don't have the years there. So what years are you comparing this data over, like 1, 2, 3, 4, 5, 6? I just want to know what time period is this?
Oh yeah, we actually did it for the last 10 years.
Okay, so which does it include 2020 or does it not include 2020?
No, we didn't include 2020. No.
Because I mean, if you see the net debt to EBITDA, actually this conveys a wrong picture here, because the net debt for the company did increase significantly in 2020 because of the acquisitions they've done. So, I mean, which is why this chart, I mean, these charts don't seem very, very correct to me.
We did that because we thought, well, because of the acquisitions, 2020 might have been more of an anomaly, really, and we wanted to kind of capture the long-term trend.
Okay. And you also mentioned that you expect the district cooling demand to triple by 2030. I just wanted to know, where did you get that from?
I think this was actually on their website, on Tabreed's website.
Okay. Okay. And, in terms of the 1.5% inflation, where did you get that from?
That was a report. I don't exactly remember which agency, but it was a report talking about the credit ratings, and it mentioned the inflation, expected inflation.
Okay, fine. Okay, that's it from my side. Thank you, ladies.
Marwan.
Thank you, ladies. Thanks for the effort. Well, a couple of just simple questions. So you decided to use dividend discount model. I can see the rationale for that, but first, why did you use growth rate of 5%? Like, what was the rationale for 5% growth rate? And that's infinite growth rate, is just right? You use a multi-stage dividend, or you use kind of a simple dividend discount model?
No, simple, so it's right, yeah, infinite.
So you use the simple one. So why did you use 5%, kind of a growth rate into infinity?
That's actually an assumption that we had to make, but relying on really the growth rate of the industry as a whole, and with also the growth of the real estate market in the region, especially with a lot of prospects in Saudi Arabia at the moment, and because they started even expanding in Dubai, their main operations were in Abu Dhabi, and they usually sign large contracts with those huge real estate developers and governments. So that's mainly why we assumed the growth.
It was more or less some kind of a feeling, or you use 5%? So just
no, we used an average of the growth rate of the industry of district cooling and the growth in real estate as well.
Okay, and you mentioned Saudi a couple of times. How big is their operations in Saudi today as part of total revenue? And did they mention that they want to increase that, like to expand into Saudi?
They mentioned expansion in the GCC in general, but since they have plans to expand the GCC at the moment, Saudi is a lucrative market, so it will be good to assume that actually they will expand there.
Okay. Taran, back to you. If you have other questions, leave some time for you.
Sure. Yeah, thanks, Marwan. I just want to understand, how did you break down their business in terms of, the different businesses that they have, and what do you think of the growth in their value chain business?
Sorry, I don't quite get the question.
So if you look at their financials, there are two distinct business segments that they talk about. Did you look at the revenues when you were analyzing their revenues? Did you see that there are two basic different business units that they have, or business verticals? One is the chilled water supply, and one is the value chain business.
Yeah, we've seen that. Basically, the value chain business being expansion through like subsidiaries and acquisitions, and then the chilled water being the service that they provide. So these are the two business models that they have.
Okay. No, so I think the value chain business is mainly more about the engineering and consulting services that they provide, which may not necessarily be where they end up supplying chilled water, but a lot of times it will be to clients and consultants who are also engaging with them for a long-term chilled water supply. And I was just thinking if you had any thoughts in terms of how that would be linked to the real estate development which is happening in the GCC, and what kind of growth you expected in that. But okay, so moving on, if you look at their financials, suddenly in 2020, in the year end, they had this big jump in intangible assets. I was just wondering if you had a look at it and you could explain what that intangible assets were.
Oh, we actually didn't look into that.
Okay. Cool. No, thanks so much. That's it from me. I think you guys did a good job. Thank you.
All right, thank you guys. Thank you ladies so much for your time. Let's please have a separate chat with yourself and Dr. Chris as to why you received the communication a little later than usual, but fantastic effort. You'll be receiving your amalgamated grades for the written report and for this presentation in the next 24 hours. So please stay tuned. Yeah. Thank you so much and have a great day ahead.
Thank you.
Thank you. All right, judges, we're gonna let the new team in. This is Middlesex. Please take down your notes while I give them the initial speech. Blessy, can we let them in the room, please? I think there's one more team member, Hershey. Yeah, she's in. She is in. Good afternoon, everyone. How's it going? Can you hear me? Can you see me?
Good afternoon, sir. Yes, we can hear and see.
Sure. Thank you so much for submitting your research report earlier. And thank you for showing up to this presentation today. Your efforts are always much appreciated. And of course, congratulations on reaching this stage. As you know, this presentation is divided into two sections. First section is the presentation section. You'll have exactly 10 minutes. 1 minute before the 10 minutes are over, I'll be mentioning in the chat box 1 minute left. So please keep an eye on the chat box. After the first phase is over, you're going to a second phase, which is the Q&A with the judges, right? We have 3 judges today, Mr. Tarun, Mrs. Rashmi, and Mr. Marwan, who are all CFA charter holders, right? So who's going to be sharing the presentation?
I will be sharing.
Okay, can you please make Steny a co-host, Blessy, please? All right, Steny, can you share your, I'm sorry if I'm pronouncing your name wrong, please excuse me.
It's Steny, correct.
Yes, thank you. So can you please share your presentation?
Can you see my screen?
Yes, ma'am, I can see it. Are you expanding it or are you keeping it in this format?
I'm putting it in slideshow.
Okay, it's up to you, right? So, ladies and gentlemen, as you know, whoever is going to be speaking, they are the only ones who are allowed to be unmuted. Everyone else should stay on mute. You can keep your cameras on. I'm talking to the team members now. Yeah. Whenever you're ready, I'll start taking note of the time. Yeah, please let me know.
Yes, we're ready.
Okay, please go ahead.
All right. Investing is all about 2 things. Rule number 1, never lose money. And rule number 2, never forget rule number 1. A very good afternoon to all the judges present. My name is Steny and my team members are Harshi, Vikas, Soumya and Neha. And we represent Team Middlesex. Air conditioning represents 70% of the peak energy requirements in the UAE. Conventional cooling systems make use of a refrigerant called R22, which has a 1,800 times global warming potential than carbon dioxide. Now let me introduce you to district cooling. Tabreed is the largest provider of district cooling in the GCC. Well, have you ever wondered how district cooling works? The journey of chilled water starts from a DC plant, where it is pumped out through an underground insulated piping network. On reaching the building basement, the heat exchangers facilitate the cooling of the building, absorbing heat from the building space and providing air conditioning. The warmed water is returned to the DC plant to be recooled and recirculated. A single DC plant provides cooling to all the buildings in a surface area. Then again, why district cooling? It consumes less than 50% energy than conventional cooling. Cost savings. In a survey that we conducted among district cooling users in GLT and conventional cooling users in Karama, we found out that cost and energy consumption was lower by 53.5% in district cooling. Reduced carbon emissions. Over 1.2 metric tons of carbon dioxide was eliminated by Tabreed in 2019. This is equivalent to removing 268,000 cars from the streets every year. We initiate coverage on Tabreed with a buy recommendation, with a target price of AED 3.26 per share and upside of 20%. Our recommendation is grounded on the following 3 factors: defensive B2B business model, acquisition-led growth strategy, and finally, an environment-friendly cooling solution.
Breathe has a low-risk utility-like business model with over 94.5% of its revenue coming from the supply of chilled water. It has a two-tier tariff structure, with 60% being fixed based on the capacity supplied. It has price certain and guaranteed contracts of typically 25 plus years with less than 1% expiring in a year. 40% revenue is based on the consumption by the end user. The revenue is based on two main factors: electricity consumption backed by the stable population growth and GLA, with the penetration rate expected to be 35% by 2025. With 95% of its revenue earned through B2B contracts, it sustains a strong clientele, with 80% being government-related entities. Overall, as a result of rising awareness and favorable government initiatives, we forecast the new connections to showcase a CAGR of 10.5%. We know that a utility business showcases minimal growth rate. Then why a buy recommendation? This is because of the Breathe strategy of spearheading growth through acquisitions. It undertook two massive deals in either half of 2020. It purchased 80% stake in the DC business of one of the world's largest real estate companies, Emaar, at the heart of the city, downtown Dubai, resulting in a 12% spike in its market share in Dubai. The deal is further expected to add two plants to Subreed's portfolio by 2021. It also picked up two massive DC entities from the master developer Alda Properties at Abu Dhabi's most prominent destination, Saadiyat Island, consolidating its position of being the largest DC company in Abu Dhabi. It earns 95% of its revenue from UAE, and these acquisitions have overall led to a 24% increase in its connected capacity in UAE. We further expect a 4% increase in its market share by 2022 by way of potential acquisitions. And that's not all. The Breathe is foraying into the other markets, India being the latest by signing a 30-year concession in Amaravati. It is further expected to scale its operations geographically, with Egypt and Kuwait being top priorities at the moment. In light of the Breathe strategy, we estimate the revenue to showcase a CAGR of 4.5% with a 4.1% annual growth in the connected RT.
Now that is easier said than done, because big moves require big money. So let us take a look at how Tabreed goes about funding these acquisitions and how its financial position is impacted. Over the years, Tabreed has been able to raise large finances for acquisitions through borrowings. Similarly, in 2020, Tabreed issued a $500 million bond, inflating its debt to equity as a result. Even so, the company carries 50% gearing, a justified increase from its 44% historical average, with majority of equity backed by a high-profile shareholder base, comprising of NG and Mubadala. We expect the debt profile to revert to historical averages following deleveraging in 2025. While we don't foresee significant changes in operating margins after 2020, the company surpasses peers with a strong EBITDA margin ranging in the mid-40 percentile, rendering a 2.7 to 1 interest coverage ratio. Speaking of profitability, net profit margins are expected to grow at 8% year-on-year from 2022, averaging net returns at 27%. Revenue growth, coupled with net finance costs almost halved since 2020, allow 11% return on equity by 2025 while maintaining its historical return on asset. Having mentioned assets, Tabreed as a part of the utility industry has a heavy asset profile, adding over 100 million worth of capex each year, averaging a capex ratio of 13%. Further on, we expect this ratio to stabilize at 10% as it penetrates into newer markets. This, coupled with revenue growth and a smoothening conversion cycle, allows more free cash flows to the firm, promoting an FCFF margin of 44.1% in 2021. As a result, the company is able to pay regular dividends, such as 11 fils DPS in 2020, expected to grow at CAGR 6.8%, and a payout ratio of 67% in 2025. Having discussed Tabreed's financial positioning, my colleague will now brief you on how this translates into positive valuation.
In light of Tabreed's defensive business model and acquisition-led growth supported by debt financing, we derive a one-year target price of AD 3.26, a potential 20% upside from the closing price of AD 2.71. We have used a blended valuation methodology comprising of the dividend discount model and the discounted cash flow model with weights of 60% and 40% respectively. We have also conducted a relative valuation using global and regional utility companies due to the lack of publicly listed district cooling companies. The price to earnings and price to book value forward multiples support our buy recommendation. Amid our favorable valuation results, we expect moderate risks to Tabreed's target price, which is reflected in our scenario analysis. In the best case scenario, the share price is expected to reach 3.86 due to market expansion, retrofitting of existing buildings with district cooling systems, and favorable government initiatives and regulations. In the worst case, the share price is expected to fall to 82.62 following the non-materialization of acquisitions, minimal rebound from the already saturated real estate market, and the lack of tariff reductions in district cooling, thus making conventional cooling a more attractive solution. Thus, the two crucial risks that Tabreed faces are the glut in the real estate market and the financial risk due to the heavy debt funding. For instance, if Aldar were to halt their project, Tabreed would be unable to commence operations on its plant, thus adding pressure to the heavy financial leverage. The valuation risks include cost of equity and terminal growth rate being the key variables. A 1% increase in the cost of equity would result in a hold recommendation. My colleague Neha will now like to explain why Tabreed is suitable to an ESG investor as well.
There has been a growing trend towards ESG investments. Investors are no longer just interested in the financial performance of a company. They are looking for companies who will fulfill their responsibility towards the environment as well as a society. In 2020, $400 million worth of AUM were invested under ESG in the US alone. Investors are looking at this as an increasingly important criteria before arriving at their investment decision. After extensive theme analysis and research, we have given Tabreed high rating in terms of environment. This is due to the various initiatives taken by them, including participating in the UN Environment-led Cool Coalition. In terms of society, we have given them a moderate rating. While they have highly contributed to the development of the local society, equal opportunities haven't been given to all. However, they do support female agenda and recognize the important role women play in the development of the society. In terms of governance, Tabreed is led by Mr. Badr Al-Lamki, who has more than 20 years worth of experience in various sectors. Moreover, the number of mandates held by NEDs outside Tabreed are not of high concern. Therefore, the company is set to practice good corporate governance. Hence, we would recommend Tabreed for any investor in the UAE looking for sustainable investment. To conclude, we recommend a buy decision for Tabreed at a target price of AED 3.26 per share with a potential upside of 20% due to the following reasons: a defensive B2B model, acquisition-led growth, and environment-friendly cooling solution. Thank you.
Thank you, ladies and gentlemen, so much for this smooth presentation. You will now be starting the next phase of this presentation, which is the Q&A with the judges. Again, judges, it's Tarun, Rashmi, then Marwan. Please go ahead whenever you're ready. I'll start recording the time. Tarun?
Hi, can you hear me?
Yes, please go ahead.
Thank you, guys. On a lighter note, I feel very threatened on my job, given the quality of your presentation and seeing what kind of students are coming into the job market. I think it was an excellent job. And, I think there are very little questions that are there. I would just like to understand, your choice of valuation methodology. You gave 60% weightage to dividend discount model and 40% to free cash flow. Is that correct?
Yes, sir.
Okay. And so generally, utilities worldwide lend themselves very well to dividend discount model. But what you also need for dividend discount model is a stable cash flow structure. Now, given these acquisitions and given that debt went up by more than 100% from 2.6 billion to 6.3 billion dirhams, I don't know how much dividend discount model could be used for. I don't know how you normalize for that. And, just some thoughts, if you can share on why you didn't use maybe a comparable company comparable multiple kind of a model?
So firstly, we used the dividend discount model and gave it a 60% weightage because since being a utility company, as you said, we believe that dividend is something that every investor looks for. But we have also given a 40% to the discounted cash flow model because currently the company is in a growth phase and the market, we believe, the price in the market, we believe has not rightly considered the acquisition growth potential and the emerging market growth. then we have not used an exit multiple as such, because there were not too many directly comparable companies for Tabreed, because the most of the district cooling companies are unlisted. Does that answer your question? Have I missed out any part in the question that you asked me?
No, thank you. I think that was a reasonable answer. Over to you, Rashmi.
Thank you, Tarun. So hi guys, I'm Rashmi, and very good presentation. I was really impressed. You did a marvelous effort here. So I have a couple of questions. So one key theme behind your analysis is growth led by acquisitions, right? Now, this company has already done 2 big acquisitions in 2020. And I mean, in terms of leverage, they're pretty much high up there, right? So how much headroom do you think they have for more acquisitions given this level of leverage? And so how do you foresee their growth being led by acquisitions in the future?
I would like to take that question. So, ma'am, as you rightly said that the company is highly levered. However, we expect the company to delever by 2025 as they make their bullet payments. And the cash control of the company is also expected to improve, as I mentioned in my part. And therefore, after the company deleverages, we expect the company to move on to further acquisitions. And also, as revealed by the company prospects as well, they are expecting to make some acquisitions in Dubai, and they also have a loan authorization by the shareholders. And therefore, that's why we incorporated acquisitions as a main part of our growth strategy for Tabreed.
Right. And one more question. I mean, this is more of a clarification that I need from you guys. So, you've done a sensitivity analysis where you've used the terminal growth rate versus the cost of equity. Is it the cost of equity you guys wanted to use, or was it the WACC?
It was the cost of equity, because we have considered the risk premium and the beta according to what the expected risk would be from entering into new markets. So we believe that is the only thing that would alter our WACC as well.
Okay, because given the capital structure of this company, debt is a very important component of their capital structure. So from that perspective, I think for a company which has a high level of debt, a WACC is a more suitable, sensitivity input to be utilized in an analysis like this.
Yes, ma'am. We'll thank you for your insight on that, but we will incorporate it in the future. But as a team, we decided to go ahead with cost of equity because the cost of debt has been pretty much constant for the company, even after the debt that they've taken at around 4.85 to 5%. And the cost of equity we thought would change because of the acquisitions and the entry into new market.
And that's a fair point. But, in the current environment, if you see what is happening is globally, we are expecting inflation to increase. We've been in a low interest rate environment for a very long time right now. But if you look at the bond yields, they've been rising recently, and stock markets do get impacted by that, as do individual companies. So I think going forward, that should be something that you might want to consider in our analysis.
Yes,
but well done.
Thank you. Thank you for your input. We will definitely consider it and we'll make the changes.
Okay, great. That's it from my side. Thank you.
Marwan?
Yeah, thank you, team. That was really an impressive effort. So probably just basic stuff. I'm looking at your forecast and projections. So you expect kind of a finance cost to kind of burden the bottom line for this year, and I see growth is a bit limited, to be honest with you. And I see your interest finance is kind of a stable as well. But mainly, I mean, I can't get that, 2025 projections. Where do you get that revenue will grow from 1.7 billion to almost 2.1 billion by 2025? Where is this gonna come from, this growth?
So, sir, we have So for revenue, the main driver for revenue for this company was connected capacity. So we've modeled that using electricity consumption and GLA. And in the years 2021 and 2022, we expect 2 acquisitions that the company will undertake. And from the years thereon, we expect only an increase in the market size as a result of increase in electricity consumption and GLA. So that's how we've predicted the
So you use GLA as an input, and accordingly, like more of a population growth. You mean like you would? So because
yes,
even if
so we've predicted electricity consumption using the population growth, and then we've used GLA as well. So these 2 were the variables used to predict the increase in connected capacity.
okay, and where did you get this GLA growth?
Samya, would you like to say?
The GLA growth, we got it from the JLL report about the forecasted GLA.
Okay, fair enough. Thank you. And but you mentioned something about acquisitions. Are you incorporating any future acquisitions into your forecasts?
Yes, sir. So
we've included 2 acquisitions, one in the year 2021. This year, we've included the acquisition of Dubai airports, and currently the company also gave a confirmation that it would be acquiring Dubai airports. And in 2022, we expect Tabreed to acquire the DC plant of Majidal for them.
So do you have details about these plans and the valuation for these acquisitions to incorporate them?
Yes,
and
sir.
If yes, where did you get it from?
Yes, sir. So the company had made a statement in November 2020 saying that they had taken a 500 million bond for acquisitions. And in their earnings presentation, they had mentioned how much is the potential RT acquisition. So the RT that they have already used up is worth 24,000, which is for the Saadiyat Island, and the remaining, the 95,000 as Steny has shown on the screen, the remaining is what we have taken as the potential acquisitions.
Yeah, that's really good. Just a small thing here. I think it was really fine what you guys did on this presentation. But for the acquisition, I would put more of a under the scenario analysis, maybe the blue skies or whatever, rather than assume it's a definite, because we've seen many negotiations actually eventually break down. So just highlighting that to the decision maker. And then, you can put your own input in terms of probability of these acquisitions actually going through. But highlighting with or without acquisition, that would be great. But that doesn't make it any less great, to be honest with you. Great job. Thank you.
Thank you so much, sir. We will consider your input and we'll make the changes.
Any other questions, judges? We have 1 minute exactly left. Tarun, can you unmute yourself?
Sorry, I had one. I just wanted to understand. So they raised a $500 million debt, and the bond was issued at a 2.5% coupon. And your cost of debt, what have you used as your cost of debt, and how does that correlate with the bond coupon?
So we used a cost of debt of 4.85%, and as you rightly pointed out, it is way higher than the current coupon rate. But the reason we have taken it as 4.85 is to incorporate the interest rate risk that they would incur from the LIBOR and EBOR rates. So we have considered that also.
But the 2.5 is fixed, or is it based on LIBOR? It's not a margin on top of LIBOR, yeah?
The 2.5% is fixed, and the LIBOR and EBOR carry margins for the other term loans that they have. Great.
Okay. No, I understand that. The right thing is it's not just the bond coupon, but the actual all-in cost of the bond, which can fluctuate with the price that it is issued at. But it's a good response. Thank you.
Thank you, sir.
Thank you so much, team. Again, great presentation, great efforts. You'll be receiving your accumulated grades for the written report and for this presentation in the next 24 hours. So please stay tuned. Thank you so much, and all the best.
Thank you.
Thank you, sir.
Thank you, sir, and thank you, judges.
Thank you, judges.
Thank you. Great show, guys.
Thank you so much.
Judges, I think you have few minutes to note down any comments or grades that you'd like to input. The next team, we finished early actually by around 6 minutes. So the next team should be here in exactly 5 to 6 minutes, yeah. Okay. Hey guys, can you see me? Can you hear me?
Yes. Hello.
How's it going? All good?
All good, yes.
So thank you so much. I'm sorry, please go ahead.
No, I was wondering if you were able to figure out the issue with the teams before.
Yeah. It's okay. They just logged in half an hour late, so it's all good. Thank you so much for submitting your written report, and thank you so much for showing up to this presentation today. Great effort so far. Please keep it up. You'll be receiving the grades for the written report and for this presentation the next 24 hours. But for now, this is the time for the presentation. As you know, this presentation is divided into two sections. First section is the presentation section. You have 10 minutes. 1 minute before the 10 minutes, I'll let you know that there's 1 minute left, right? Once that is over, you go into the next phase, that is the Q&A phase with the judges, right? Again, you will have exactly 10 minutes left. Once that is over, again, just reiterating, you'll be receiving the grades of both in the next 24 hours. Please keep an eye on the chat box because this is where I'll be mentioning 1 minute left so that I avoid disrupting you or stepping into the presentation or anything like that. Can you please let me know who's going to be sharing the presentation?
And that's going to be me, Julius.
Right. Can you make Julius co-host, please, Bletzy?
Okay, I'm the co-host now.
Yeah.
Yeah. Can you please share your presentation? Okay, judges, can you see and hear everything, right?
Yes, I can.
Right. So just ground rules, guys. Whoever is speaking is the only one that should be unmuted with the camera on, and everyone else should be on mute. And I assume you know your turn, so please act accordingly. Whenever you're ready, please let me know, and I'll start taking a note of the time. Yeah.
Okay. Yeah. I think we're all ready from our side.
Okay. Good luck. All the best. Please go ahead.
All right. Hi, everyone. We're the team from New University Abu Dhabi, and it's our pleasure today to present you why we think that Tabreed is heavily undervalued. Based on our analysis, we think Tabreed should have a target price of 4.46 dirhams, which represents a 68% upside from the share price on January 5th, which was 2.65 dirhams. But before we go into the details, let me quickly introduce the team to you. This is us, and each one of us is going to be presenting to you one reason why we think that Tabreed is heavily undervalued and is a buy recommendation. But now let's get into it. And Raja, why don't you take it from here?
Sure. Let's start with the industry. District cooling is a $27.8 billion industry with a 7% CAGR. In examining Tabreed's role in the market, our team identified three primary categories of focus: demand, drivers, and dominance. Let's start from the bottom. The first one is quite obvious. Industries like district cooling experienced saliently surging demand year-round, fueled by excessive MENA region heat during on and off cycles. Cost scalability and operational efficiency further fuel demand for district cooling over unit cooling. Looking across industries, there exist two fundamental intrinsic drivers of district cooling demand volume: real estate development and travel and tourism. With these in mind, Tabreed is poised for clear dominance with over 80% of the UAE's district cooling market share and immense acquisitional expansion. Next slide, please. Let's now look at Tabreed as a company. Geographically, it operates in 5 GCC countries and a 6th in India's Amaravati region. With 22 years of operational history, 80 plants, and over 1.3 million cooling tons delivered per annum, with expansionary endeavors such as the Jabal Omer project in Mecca continuing to increase overall output. Tabreed's technological offering is quite simple. Bringing in chilled water from the sea, centralized cooling plants provide cooling to building systems via a network of underground pipes. In comparison to traditional per building unit cooling, DC reduces energy expenditures by up to 50%. Next slide, please. All of this flows into Tabreed's greatest expertise, its expansionary prowess. Through a steadily consistent pace of acquisitionary endeavor, Tabreed has boosted its district cooling output capacity by over 17% in 2020, with majority stakes in MRDC and Saadiyat Cooling, just to name a few. Its growth both within the UAE and internationally is driven by this capability, with sufficient financial liquidity and operational finesse to strike deals across the gauntlet of district cooling markets. I'm now going to pass my time to Vlado, who will walk us through some of the ESG metrics associated with Tabreed.
Thank you very much, Raja. Now, from an ESG perspective, Tabreed has done outstandingly well within the regional context. They've maintained a great amount of transparency, with the vast majority of board members being independent and not holding shares in the company, so clearly trying to keep an unbiased board. And that has translated into structured management with 5 separate and independent board committees, as well as external audit services. That has translated into quite an efficient business operation as well, with the company being divided into 5 units, specialized by target, market, and subsector. And in turn, that efficiency and organization has resulted in them achieving their key ESG objectives, the environmental objectives being key. Specifically, saving 2.06 billion kilowatts per hour in 2019 through their operations, and equally being involved in the community by partaking in the World Energy Congress and UN Climate Summit in 2019. That has also translated into outstanding ESG metrics for the company, with 41% amortization levels across the corporate operations, a key goal in the UAE that is upheld by Tabreed, and 78% of the shares being held by Engie and Mubadala, so excellent expertise from abroad and brilliant domestic understanding of the market through Mubadala ownership. That has resulted in the company being ranked in the top 3rd regionally by ESG metrics as per ESG Invest, and we clearly see a great level of commitment from the company to its success, with 90% almost board meeting attendance rate and 0% reported incidence rate in 2019-2020. I'll now pass over to Alex, who will walk us through some of the financials.
Thank you, Vlado. Understanding the company's financial performance is key to do the valuation precisely. In the graph below, we combine historic data with team forecasts for the future. It is clearly visible that most accounts were showing a consistent growth trend up until 2020, where several massive M&As occurred, distorting the previous dynamics. This was reflected in a jump in assets and liabilities through a debt-financed M&A in 2020, followed by a spike in leverage, which we expect to gradually decrease over the next several years. Revenues, gross profit, EBITDA have been growing consistently at approximately 6% compounded annual growth rate. In turn, profit margins have been relatively constant. Operating cash flow has been growing steadily and is expected to benefit from the M&A. Financing and investment cash flows reflect the acquisition in 2020. Return on investment capital and return on equity have also been growing steadily, with an M&A-driven fall in 2020. Plant capacity was considered as a KPI. It follows the general tendencies with a high expected growth in 2020. Thus, we can conclude that Tabreed has a stable financial performance and has partially shifted into the acquisitionary model with a strategic focus on market share consolidation through buying the smaller players on the market. Now to Yao and the valuation part.
Thank you, Alex. Now moving on to Tabreed's valuation, we have utilized DCF analysis, public comparables, and precedent transactions multiples to evaluate it. And we used a 60%, 30%, and 10% weightings for the 3 methods. Beginning with the DCF model, we have come up with the WACC of 6% and a terminal growth rate of 1.5%. With these figures, we expect a fair price based on our DCF analysis of 4.31 dirhams, which represents a 33% upside from its price of 2.65 dirhams recorded on January 5th. Next slide, please. And with factors such as the 5-year monthly beta taken from Bloomberg and also its current capital structure of 51% debt and 49% equity, we reached the WACC of 6%. As for the terminal growth rate, Tabreed's business is mainly involved in the UAE. Therefore, we believe that its growth rate will be lower than the UAE economic growth rate. To give a more conservative estimation, we thus set the terminal growth rate at 1.5%. Our team also ran multiple scenarios reflecting the effects of potential changes to either the WACC or the terminal growth rate in our DCF model. And among all the results, as we can see, only one situation resulted in a neutral return, and all the other situations indicated very positive returns. Now passing on to Julius.
Right. For comparable multiples, we wanted to go a step further and not simply look at average, but by running regression and controlling factors such as margins, growth, and risk, we think we can have much more accurate multiples which predict the real value of Tabreed compared to its peers. As you can see on the left, if you just look at an average ratio between price to revenue and net income margin, you see that with varying net income margin, you have different price to revenue ratios, and such approach can be much more accurate. So what we did is then we looked at the 3 different comparable groups. We first looked at the local industry, which we defined as the MENA region, and we defined it as the electric utility companies, since they tend to be very similar to the district cooling area, and there are not enough district cooling companies. So we first looked at the local industry, then we looked at the global electric utility industry, and lastly looked at the overall market of all public companies. So running these regressions and getting different ratios for those gave us different price predictions for Tabreed. As we can see, nearly all of them tend to give us an upside and a buy recommendation for Tabreed with an average of 5.07 dirhams, which is a 91% upside. Then, as a third step, we looked at precedent transactions. What we did here is that we looked how much Engie paid for Tabreed in 2017. And based on this kind of implied multiples, we used those and then multiplied them with the values of today. And then again, we got a positive, an upside and bullish price of 3.55 dirhams. So to kind of summarize our valuation, we see that across all 3 valuations, we have a very strong buy recommendation, which gives us, based on the weights that Yao mentioned earlier, a target price of 4.46 dirhams. Now back to Alex.
Several changes occurred since the date the report had been drafted. First of all, the stock price increased. Second, 2020 annual report was uploaded. We followed a conservative approach in our forecasts, and the actual values were in fact higher than team estimates. Thus, our final recommendation was supported. Next one, please. Investment risks are important to make an informed decision. We constructed a risk matrix reflecting the probability and the magnitude of each of the positive risks. The first one includes strategic outlook, UAE market approaching maturity. As for market trends, the perspectives of district cooling shrinking are highly unlikely. As for geographic concentration, Tabreed has weaker positions abroad, which could be a little more concerning. Finally, macroeconomic aspects such as Middle Eastern unrest and COVID crisis affected all the industries. Nonetheless, there are no urgent and pressing risks among the aforementioned, and all of them are possible to be mitigated by thoughtful strategy. Now back to Julius to sum it up.
Yes, I think we have presented you with 5 clear reasons why we think Tabreed is a clear buy, and we have also looked at the risk which we didn't think was substantial. Thus, we think Tabreed is a clear buy, and we thank you for your attention.
All right, gentlemen, thank you so much for this smooth presentation. Well done. Now you'll be entering the next phase of this presentation, which is the Q&A phase. We'll be going forward with Rashmi, Marwan, then Parwan. Rashmi?
Yes. Hello, guys. Well done. It was a good presentation. My name is Rashmi, and I'm one of the judges today. So I wanted to first ask you in terms of the leverage of the company. I mean, you're of course very, very bullish on the company. So I wanted to know, what do you think about the leverage and how does that build into your analysis? And does it impact the valuation anywhere?
Yes, thank you for your question. With regards to the leverage, we considered the leverage spike in 2020 to be the highest in the analysis that we're conducting, and we're expecting the scale of M&A to decrease to a very low rate in the next following years. So therefore, the company's target is to decrease the leverage in the next further years. However, we also incorporated the current high levels in our valuation as well.
Okay, and in your calculation of WACC, can you tell me how did you arrive at the risk-free rate calculation?
So
if you can
yes,
go back to that slide.
Yeah. Yes, of course. So, of course, we know that Tabreed has a very extensive business in Abu Dhabi, and as well as is expanding in Dubai as well. So, we do know that for the risk-free rate in Abu Dhabi, it's currently at around 2%, but we use 4.2 because we believe that this rate is likely to increase, and also considering that the real rate is actually potentially to be negative, we believe that adding this 2% rate could be considered as a buffer for the risk-free rate in the future. And considering that WACC at this point is already so low, we also want to basically increase it to make it more, can reflect the actual value of this company.
Okay, and what are the main assumptions behind the revenue growth that you've taken in your model?
Yes. So behind the revenue growth, we start by looking actually at the Tabreed's company capacity, and we first added basically the 2020's acquisition of Emaar's district cooling, and then we also take into account this year's Saadiyat Islands district coolings, and then from then on, we assumed a 1.5% in the capacity increase, and based from that, and we developed our revenue growth.
Okay, great. Thanks a lot. I'll give time to the other judges now to ask their questions.
Thank you.
Yeah, thank you, Chief. That was a good one. Probably I just want to go with you through the valuation of the company. So you took Engie like kind of implied multiple, and you arrived at a target price of 3.55 as implied EV/EBITDA of 17 times and implied PE of 17.78 as well. So at that point in time, okay, so you use that multiple with the current valuations, and you arrived at 3.55, correct?
Yes.
All right. So do you believe that us as minority shareholders should pay the same multiples as Engie did when they took over 40% of the company?
Yes. I mean,
if yes, why? If no, why as well?
Yeah. So I think firstly, what we have to consider with these multiples, we have obviously factors that might go in a downward direction and an upwards direction, right? So one of the things that we have to consider, first place, for example, is that since then we have seen a decrease in interest rates, right? So that obviously with the companies that with stable cash flows, like Tabreed would probably even give them a higher multiple now. So that's, for example, one thing that goes in the upwards direction, right? On the other hand, it's a very fair argument that probably Engie, who probably wants to have, has a bit of a control premium because they acquired a large major stake, might actually be willing to pay a bit more than the normal investor, right? But again, as I'm saying, there's effect going in different directions, and I agree, we could discount the kind of control premium, but in this case, we didn't do it because, as I said, there is effects going in both directions, and we just wanted to be neutral in that respect.
So you decided to negate the control premium because of the lower interest rate.
Right, right. I mean, we tried to do a simpler approach, but in this case, we didn't consider control premium. Yeah, that's correct.
Okay, and for a company like Tabreed, you know, I think given its utility and let's say growth should be, apart from acquisition on the side, should be predictable. Assume unless acquisitions are done on a really deep discount or more of a favorable way, because I would say most of the time acquisition of such industries takes place at fair multiples, as we've seen in the case of Engie acquiring part of the business, if I'm not mistaken. It's not higher actually, which should harm the breed. So the bottom line here, you didn't even consider, given that we're a minority, we should at least look at the dividend discount model rather than the DCF. And yeah, I would like to hear your thought on it.
Could you repeat that? So why we didn't use a dividend discount model instead of a DCF?
Why didn't, for us, because we're gonna buy the stocks from the market, right? So given that we are minority stakeholders in this company, shouldn't you at least give us the overview of from a dividend perspective what we should expect? And
I think
consideration.
Yeah, I think a dividend discount model is also a way to go about this, but I think DCF also gives you the value. What we did with the DCF is we projected out all the cash flows and then potential dividends going forward. And as the minority stakeholder, right, you still own part of the company. So if the DCF, if we actually determine the actual value of the company, this also gives us a fair assumption of how highly this company is valued, right?
Right. Okay, so that leads me to my next question. So what kind of a dividend do you expect from this company, given that you did the DCF? What should we expect? So
yeah,
and at 4.3, what kind of a yield we will be getting?
Yes, I'll take this question. So originally, we do expect that the dividend will actually go up, but actually, according to the recent report issued by Tabreed, they actually cut it down a lot to 0.575. So from this, because they do that because they want to de-lever the company's leverage in a more efficient way. But we do believe that going in the future, considering the company's current promising revenue growth and everything, we do believe that the dividend will still grow in the future, and that can still be beneficial to the investor, both minorities or majority stakeholders.
Right. Thank you, gentlemen. Darren, move to you.
Thank you, guys. I think it was a great presentation. Really enjoyed it. Just going back to slide 14, if you will. So let me just ask you this quick question. It's not very usual to see that you say that the risk-free rate is 4.2%, but the company's cost of debt is 4%. It's kind of saying that company borrows lower than the sovereign rate, which the cost of debt for the company is lower than the sovereign. It was a little bit kind of strange for me.
Yeah, sure. I'll explain this. So actually, if we look at Tabreed's financial report, it has basically two major parts of the outstanding debt. One is a 2.5% bond that they just issued this year, and the other one is a 5.5% sukuk that they issued in 5.5% coupon rate sukuk that they issued in 2018. So as we can see from here, that the company actually doesn't have a debt, that the cost of debt the company for the debt that the company actually issued is actually not that high. And we decided to use a blend-in average of these two bonds to arrive at a 4.0% bond rate. But actually, the actual yield maturity for the company is even actually lower than that. It's actually 2%. So I believe that this 4.0% of cost of debt makes sense.
Okay. Okay, sure. So I was really impressed by the use of regression analysis. I don't think in my many years as a judge of this program, I have seen any teams doing a multi-factor regression model. So I think that was a great thing to kind of consider. You also mentioned in your opening one of the few slides that the growth of district cooling you feel is driven a lot by the underlying residential growth in residential real estate and travel and tourism. Could you explain the travel and tourism angle to me, and how critical is that for your projected model, projected revenues?
Yeah, this is a really good question. Given the COVID-19 pandemic, the situation globally, we definitely anticipate travel tourism returning back to the UAE. And given that travel and tourism feed directly into real estate and the development of new properties, new commercial, real estate outlets or retail outlets, it is very important. And frankly, we don't anticipate these macroeconomic effects really affecting the company or the future of DC in the UAE for too long after the vaccines are rolled out this year.
I see. So you're saying that the real estate development does not, in your model, you did not incorporate the same, the hospitality and retail in the real estate, but you consider real estate only to be residential. Is that correct?
Not necessarily. I think commercial and residential were considerations we took into mind, given that Tabreed, the UAE, it kind of operates in both spaces within the UAE. So we did consider both in that assumption.
Okay, great. I really loved your presentation, guys. Thank you. That's all for me.
Thank you so much, gentlemen, for this presentation. Thank you for taking the time to be here today. We really appreciate it. Again, fantastic efforts so far. You'll be receiving the accumulated grades in the next 24 hours, so please stay tuned. Meanwhile, if you have any questions, you know how to reach out to me. And thank you very much and have a great day.
Thank you, Mark, and thank you, judges.
Thank you very much.
Thank you very much.
Thank you, Mark, and thank you, judges, for your time.
Thank you, guys.
Thank you.
Julius, may I kindly ask you to exit the room?
Yes, sir. I'm done with my. Okay, now I'm funding them.
Oh, that's okay. That's fine.
Right. I think they've all gone. Just us now.
Yes. Well done.
Well
Great
done.
day. That's a wrap.
That's a wrap. Absolutely. Yeah.